Responsible investing is evolving rapidly. Today, it includes diverse strategies that come with a complex array of terms, making it challenging for investors and advisors alike. In this session, we'll simplify and explore the 7 responsible investing strategies. This video has been accredited for CPD points by the Financial Advice Association of Australia. To receive a link to the quiz that demonstrates competence in the subject matter, please email Pella Funds Management using the contact details provided at the end of this video.
Today's session will guide you through a concise 30-minute exploration of responsible investing, structured into 5 key sections. We'll begin by defining responsible investing, laying the foundation for our discussion. Next, we'll explore the unique characteristics of the 7 responsible investing strategies, providing a clear understanding of their fundamental elements. From there, we'll synthesize these insights, forming a comprehensive picture of how these strategies interconnect. We'll then focus on the critical topics of carbon intensity and identifying activities that create a positive impact. Finally, we'll address common misconceptions and share tips to boost your confidence in responsible investment practices. Let's dive in and unlock the essentials of responsible investing together.
Let's start by acknowledging that there is not a universally accepted, scientific definition of responsible investing. This lack of standardization has led to a variety of terms used to describe this approach, creating some confusion among investors. To address this issue, major organizations such as the CFA Institute, the Global Sustainable Investment Alliance, and the United Nations Principles for Responsible Investment collaborated to establish harmonized descriptions of responsible investing strategies. Today, we're going to explore the outcomes of this important collaboration. We'll dive into how these unified descriptions provide a clear path through the evolving world of responsible investing.
The 7 responsible investing strategies are ESG integration, positive or best-in-class ESG integration, negative screens, norms-based screens, stewardship, positive impact investing, and sustainability-themed. Let's take a closer look at each strategy.
Let's take a moment to understand how environmental, social, and governance factors are assessed. Environmental and social factors are evaluated differently from governance factors. Assessing environmental and social exposures follows a 2-step process. We begin by identifying the investment's key external exposures. These exposures largely depend on the investment's key activities or locations of operation. For example, companies in the financial sector usually face material social factors and less material environmental factors. On the other hand, energy companies tend to deal with higher environmental factors but relatively lower social factors. After identifying the key external exposures, we evaluate how those exposures are managed. This is very important because it determines the impact that the key exposures have on the investment. An investment facing significant environmental or social risks can still have strong environmental or social characteristics if those risks are well managed. However, if management is lacking, then even investments with lower environmental or social exposures may have weak environmental or social characteristics. Governance is assessed differently because it is not influenced by external exposures. All investments are subject to similar governance considerations, regardless of their activities or location. This means that when evaluating an investment's governance characteristics, we focus on internal factors, such as board independence, internal incentives, and ownership structure. So, what exactly does it mean to integrate ESG factors within the investment analysis process? Investors consider their own set of factors when evaluating an investment. These factors can include balance sheet, macro outlook, track record, return on capital, growth outlook, valuation, and several other factors. ESG integration means that along with those traditional factors, the investor also considers environmental, social, and governance factors. Investors continuously balance these factors, making trade-offs where necessary. For example, they might pay a premium for investments with superior ESG metrics, or demand a discount for investments with poor ESG metrics. In practice, investors who apply ESG integration treat ESG metrics with the same importance as traditional financial measures, giving this approach equally strong ESG and traditional investment characteristics. The key takeaway is that ESG integration embeds environmental, social, and governance considerations along with other factors into the investment research and decision-making process.
Let's delve into our second responsible investment strategy, which involves two closely aligned sub-strategies: positive ESG integration and best-in-class ESG integration. These sub-strategies elevate the role of ESG considerations, from being one factor among many to the centerpiece of the investment strategy. Their goal is to prioritize investments that demonstrate exemplary ESG characteristics. Positive ESG integration searches for investments that exhibit strong absolute ESG credentials. It's about finding ESG leaders across the entire investment universe. Best-in-class ESG integration seeks investments whose ESG metrics outperform their direct peers. It's about finding the leaders in each sector who are setting the standards for ESG practices. The crucial point about these strategies is that they do more than just include ESG factors in the investment process. They actively prioritize investments that excel in ESG standards.
Now, let's move on to our third responsible investment strategy: negative screening, also known as exclusion screening. This method is a cornerstone of what many consider ethical investing. Negative screening focuses on minimizing or completely avoiding investments whose core operations clash with ethical criteria. The criteria can vary widely, but typically include product categories, which deals with investments that make money from products that contravene the ethical standards, such as weapons, tobacco, or operate casinos. Practices, which deals with investments whose activities contravene ethical standards. For example, avoiding firms that conduct animal testing of cosmetics. And places, which deals with investments based on the location of their operations. For example, steering clear of companies based in regions considered hostile or high risk. By applying these filters, we narrow the range of investments to avoid those that don't mirror our ethical convictions. The negative screening strategy involves two critical steps. First, we establish which ethical criteria to apply to our investments. Then, we determine the maximum allowable exposure to these criteria, which can be quantified in several ways, such as the percentage of revenue from excluded activities or the percentage of assets in specific regions. Consider a practical example with these weapon manufacturing companies. Lockheed Martin generates most of its revenue from weapons. Boeing derives 20% to 30% of its revenue from weapons. Daikin earns less than 10% of its revenue from weapons. Examples of investors with different threshold requirements for exposure to weapon manufacturing include Charlotte, who opts for zero exposure to weapons manufacturing; Jing, who sets her limit at companies earning more than 10% from weapons; Ahmed, who excludes companies earning more than 30% from weapons; Priya, who applies no exclusions related to weapons. Based on these preferences, Charlotte would avoid investing in Lockheed Martin, Boeing, and Daikin. Jing could invest in Daikin, but not in Lockheed Martin or Boeing. Ahmed could invest in both Daikin and Boeing, but not Lockheed Martin. Priya would consider investing in all three companies. This scenario highlights how exclusion screening creates definitive boundaries for investments. Essentially, this strategy limits the pool of investable assets to reflect personal values.
Next, let's delve into norms-based screening, our fourth responsible investing strategy. This strategy focuses on excluding investments that have behaved very badly, regardless of their industry, location, or core activities. These behaviors typically come to light through self-disclosures, media reports, or insights from specialized research providers like MSCI or Sustainalytics. One of the main challenges we face with this strategy is determining what exactly constitutes a norms-based breach. For this, we often turn to international standards such as the United Nations Global Compact or the OECD guidelines for multinational enterprises. Let's examine some real-world examples where companies have violated these norms. First, there's the Dieselgate incident, where Volkswagen was found to have installed software in diesel vehicles to cheat on emissions tests. Then we have the LIBOR scandal involving Barclays Bank, which manipulated interest rates to benefit its trading positions. Next, the Horizon oil spill, where BP's alleged negligence caused extensive environmental damage in the Gulf of Mexico. We also have the Cambridge Analytica scandal, where Meta, formerly known as Facebook, used user data without proper consent. And lastly, Purdue Pharma's role in the opioid crisis, where their aggressive marketing of OxyContin contributed to widespread public health issues. Committing a norms-based breach does not permanently exclude an investment from our investment universe. If an investment involved in such a breach demonstrates a genuine resolve to rectify the issue and ensure it does not recur, they should be considered for re-entry into our investment universe. This brings us to a crucial point. Norms-based screening is about evaluating an investment's behavior, not just its core exposures. Importantly, investment candidates can rectify these behaviors, which is a significant aspect of this strategy.
Let's now turn our attention to the fifth responsible investing strategy, stewardship. This concept extends beyond the allocation of capital. It's about using our rights and influence as investors to protect and promote the interests of our clients and the other stakeholders. Stewardship can be exercised in various impactful ways. For instance, engaging with investee companies to understand their perspective or encourage better practices. Participating in shareholder votes to demonstrate our views on key decisions. Filing shareholder resolutions or making formal statements, facilitating other shareholders to participate in the initiative. Nominating directors to boards to influence governance at a structural level. Interacting with regulators and industry bodies to help shape investments' operating environment. Contributing to industry research, public discourse, or policymaking. Sharing our knowledge and insights to drive industry-wide improvements. Pursuing litigation, when necessary, to force change. The core of stewardship is being actively engaged to improve the performance of the investment and its impact on the broader community.
Our sixth responsible investing strategy, impact investing, involves investing with the deliberate intent to generate a positive, measurable social and/or environmental impact, along with a financial return. Let's explore the key dimensions of impact investing. The first dimension is intentionality. Impact investments are made with the dual purpose of improving social or environmental conditions while also securing a financial return. This dual focus ensures that every dollar invested works towards building a better world. Next, we have active contribution. This means that the investment actively targets environmental or social improvements. It's crucial to outline how the investor's actions contribute to fostering positive change. And the third dimension is measurability. It's vital to quantify the environmental or social improvements resulting from the investment. This accountability helps ensure that the impact is real. In summary, impact investing demands intentional and active contribution to positive change, along with the ability to measure that change, all while aiming for solid financial returns.
Let's now turn our attention to the final responsible investing strategy, sustainability-themed investing. This approach isn't just about selecting individual companies or sectors. It's about tapping into broader sustainability themes. It adopts a top-down approach that starts by identifying positive environmental or social themes, then identifying industries and investments that are aligned with those themes. On the environmental side, the themes can range from renewable energy, energy efficiency, low-carbon transportation, water treatment, sustainable agriculture, green buildings, and more. Turning to social themes, our focus spans education, health systems, poverty reduction, solutions for an aging society, gender equity, diversity, and more. By investing in these themes, we aim to benefit from sustainability outcomes and generate strong financial returns. The key point about sustainability-themed investing is that it's about looking at the bigger picture and focusing our investments in areas aligned with positive and long-term environmental or social themes.
Let's recap the strategies we've discussed. ESG integration involves including an evaluation of environmental, social, and governance factors during the research process, and including those factors in investment decisions. Positive and best-in-class ESG integration narrows the investment universe to opportunities with strong ESG characteristics. Positive ESG integration seeks investments with absolutely strong ESG characteristics, while best-in-class seeks investments with ESG characteristics that are superior to their direct peers. Negative screening excludes investments based on ethical criteria related to products, practices, or places. Norms-based screening excludes investments that have behaved very badly. If those behaviors are rectified, the investment can be re-included in the investment universe. Stewardship involves active engagement to improve the investment's financial performance and its impact on the broader community. Impact investing requires investments to catalyze a measurable positive change, while also generating financial returns. And sustainability-themed investing is a top-down approach that focuses investments in areas aligned with positive environmental or social themes. These are the 7 strategies that constitute the range of responsible investing strategies according to several leading industry bodies.
Carbon intensity evaluates the greenhouse gas emissions associated with an investment, measured in terms of its economic activity or output. It has become a crucial factor for investors seeking to understand and manage the environmental impact of their investments. Depending on an investor's goals, carbon intensity can be incorporated across a range of responsible investing strategies, including ESG integration. This strategy incorporates carbon intensity as one factor in assessing environmental risks. However, this strategy might still include highly carbon-intensive investments if other characteristics, such as financial returns or broader ESG performance, are sufficiently compelling. Positive ESG integration. This approach prioritizes low-carbon investments outright, focusing on reducing emissions without compromise. Best-in-class ESG integration. When applying this approach, investments are chosen for having lower carbon intensity compared to their industry peers. Sustainability-themed. This strategy may target investments that actively reduce carbon emissions, like renewable energy or sustainable technologies. Carbon intensity is measured by quantifying greenhouse gas emissions relative to an activity or output. Here are some common ways to express it. Absolute carbon emissions. Emissions relative to revenue. Emissions relative to enterprise value. Emissions relative to units of production. Emissions relative to the number of employees. While this measure is called carbon intensity, its calculation includes more than just carbon dioxide. Other greenhouse gases, such as methane, nitrous oxide, and fluorinated gases, are also included. These gases are converted into carbon dioxide equivalents using global warming potential factors, which are illustrated in this table. For example, 1 ton of methane is equivalent to about 30 tons of carbon dioxide. When calculating these emissions, a commonly used framework is the GHG protocol, which categorizes emissions into 3 scopes. Scope 1 measures direct emissions that come from sources controlled by the organization, such as on-site fuel combustion or company-owned vehicles. Scope 2 measures emissions associated with purchased electricity, heat, or steam that are tied to the organization's operations. Scope 3 measures indirect emissions from the organization's supply chain and operations, including activities like employee commuting, purchased goods and services, and the end-of-life treatment of products. Amid all this complexity, there are professional services firms that calculate greenhouse gases emissions for our use. These organizations include Bloomberg, MSCI, Refinitiv, Sustainalytics, and others. The key points are that carbon intensity refers to total greenhouse gas emissions, measured in carbon equivalent. There are several scopes to measuring these emissions, and there are professional services firms that provide carbon intensity calculations.
Both impact investing and sustainability-themed investing focus on activities that generate positive outcomes for the world. This introduces a crucial question. How do we identify investment opportunities that have a positive impact? A systematic and widely recognized method involves aligning investments with the United Nations Sustainable Development Goals, often abbreviated as UN SDGs. These 17 goals are designed as a comprehensive blueprint to achieve a better and more sustainable future for all by the year 2030. As illustrated in the diagram, the 17 SDGs span a wide range of social, economic, and environmental challenges. To genuinely ensure an activity has a positive impact, it should meet one or more of the specific Sustainable Development Goals. This brings us to an important follow-up question. How can we confirm that an activity fulfills a Sustainable Development Goal? To address this, we need to delve into the SDG hierarchy. The Sustainable Development Goals can be divided into targets, and these targets are further composed of indicators, which provide measurable criteria for positive impact activities. There are 230 indicators, which are used to create 169 targets, which in turn combine to create the 17 Sustainable Development Goals. For an initiative to be recognized as having a positive impact, it should demonstrably meet one or more of the Sustainable Development indicators. This means that while the Sustainable Development Goals are a convenient way to communicate positive impact themes, it is adherence to Sustainable Development indicators that determine whether an activity qualifies as positive impact or not. To illustrate how the United Nations Sustainable Development Goals, targets, and indicators are interconnected, let's consider Sustainable Development Goal number 2, End Hunger. This goal is supported by 5 specific targets, each of which is further defined by one or more indicators. For instance, the first target of goal number 2 aims to eradicate hunger and ensure all people, especially the poor and vulnerable, have year-round access to safe, nutritious, and sufficient food. The indicators used to measure progress towards that target are 1. The prevalence of undernourishment, which can be measured by calculating the proportion of the population with insufficient caloric intake. 2. The prevalence of moderate or severe food insecurity, which can be gauged using the Food Insecurity Experience Scale. The indicators mean that each aspect of a sustainable development goal is actionable and measurable, providing a clear pathway towards achieving a world without hunger. Let's continue examining the End Hunger Goal with an example to understand the importance of the Sustainable Development indicators. Consider a hypothetical fast food company that produces affordable food targeting lower-income demographics. At first glance, it might seem that such a business contributes to the overarching goal of reducing hunger. However, when we examine the End Hunger indicators, the alignment becomes questionable. For example, due to its typically high calorie but low nutrient content, fast food neither reduces the prevalence of undernourishment nor addresses food insecurity. It does not reduce stunting of children under 5 years old, and it certainly does not reduce malnutrition. Fast food has no impact on small farm productivity or income, and if anything, it has a negative impact on sustainable food production. Finally, fast food does not contribute to the diversity of plant and animal genetics or reducing the proportion of local breeds classified as being at risk. Consequently, this fast food business does not satisfy any of the End Hunger indicators, meaning it does not satisfy the End Hunger goal. This example helps to demonstrate that we should evaluate activities against sustainable development indicators to ensure they result in a truly positive impact.
It's important to clarify some common misunderstandings in responsible investing. Firstly, ESG integration is often confused with negative screening, but they are fundamentally different. ESG integration involves evaluating how environmental, social, and governance factors are managed within an investment. It is not an ethical judgment, as is the case with negative screening. This means ESG integration can allow investments in sectors that negative screens might exclude, such as weapons, tobacco, and fossil fuels, provided the risks associated with those exposures are well managed. Another frequent misconception is assuming that all investments in positive theme activities qualify as impact investing. One key element of impact investing is active contribution, where the investment serves as a catalyst for positive change. This generally involves investing in the primary market, not the secondary market. It's also essential to understand that an investment might align with one strategy but conflict with another. For instance, a US defense contractor like Lockheed Martin may exhibit strong ESG credentials, making it suitable for an ESG integration strategy. However, due to its involvement in the weapons industry, it would not be appropriate for a negative screening approach. Similarly, Purdue Pharma might be eligible for a sustainability-themed healthcare fund, but it would fail norms-based criteria due to its role in the opioid crisis. In summary, each strategy has its distinct principles, which means an investment may meet the requirements of one but not another. A blended approach that incorporates multiple strategies helps bridge these gaps.
Along with your own judgment, there are organizations that review funds and fund managers to help build confidence in their responsible investment credentials. Two organizations that are commonly used in Australasia are the Responsible Investment Association Australasia, RIA, and the United Nations Principles of Responsible Investment, PRI. Financial products that have been successfully certified by RIA can display the RIA certification badge, indicating their compliance with established responsible investment criteria. In addition to product certification, RIA also evaluates investment managers' commitments to responsible investment. Based on an in-depth assessment of 20 measures, RIA assigns the manager designations. Responsible investment leaders are managers who demonstrate exemplary responsible investment practices. The top approximate 20% of managers in the RIA's research universe achieve this designation. Investment managers with a score of at least 15 out of 20, but do not fall within the top 20%, are designated as responsible investors. Managers scoring below 15 do not receive either designation. The United Nations Principles of Responsible Investment does not offer a product certification. Rather, investors engage with the PRI by becoming signatories to its principles. These signatories are required to submit an annual transparency report that details their activities and progress in implementing the principles. This report is publicly available on the PRI website, which ensures accountability and facilitates peer benchmarking. The key points are that in Australasia, RIA provides the most commonly used responsible investment product certification and an assessment of the investment manager's commitment to responsible investment. Meanwhile, signatories of the PRI are expressing their commitment to the UN's responsible investment principles, but it is up to interested parties to gauge the level of this commitment by reviewing the manager's transparency report.
In conclusion, today we discovered that there isn't a one-size-fits-all definition for responsible investment. Instead, we rely on guidance from authoritative bodies such as the CFA Institute, the Global Sustainable Investment Alliance, and the United Nations Principles for Responsible Investment, which outline 7 key responsible investment strategies. We delved into the unique focus of each strategy, which ranges from integrating ESG factors and excluding certain investments based on their exposures or behaviours, to actively engaging in initiatives that drive positive outcomes or concentrating on themes that promote positive impacts. We also examined how carbon intensity is determined through total greenhouse gas emissions across 3 scopes and noted that sustainable development indicators are a valuable tool for pinpointing activities with positive impacts. Moreover, we addressed common misconceptions, highlighting that no single strategy encompasses all aspects of responsible investment. Thus, a combination of strategies is often required to fill these gaps. Finally, we looked at organizations that bolster confidence in the application of responsible investment practices. Let's use the insights we've gathered today to inform our investment decisions, ensuring they align with our goals for prosperity, societal well-being, environmental sustainability, and financial success. Thank you for joining us on this journey through responsible investing.
To earn CPD points for reviewing this content, please email us at inquiries@pellafunds.com and we will send you a link to the quiz questions needed for eligibility.
Congratulations for completing this course, and if you have any questions or comments about this presentation, please feel free to reach out to us.